Good morning from the morning reading, and there's quite a bit of content here today, but I thought it was some really good stuff, so just kind of expect a little bit more than usual. Also, the second thing from the morning reading, if you hear me refer to I, this is from the author, but not from myself. So let's dive into the morning reading. Short-term stock bounce has probably ended. A retest of summer low now appears likely. VIX bounces off the 20 support level. With the retest of the August lows likely, a short-term bounce that started nearly a month ago appears to have run its course. That suggests that a retest of the August low is more likely. The shape of the recent rally suggests that support probably won't hold. Yesterday's downside reversal day combined with today's downturn, we're referring to Thursday and Friday there, has given the recent short-term pattern a look of a rising wedge, which is a bearish pattern. That's defined by the two converging trend lines applied to the daily bars in the S&P 500. A downside violation of the lower support line would confirm the rally failure. Money leaving stocks is moving into bonds. Gold prices are also bouncing. All market sectors are in the red, with the biggest losses in energy, materials, and financials. Banks are being hurt by falling interest rate. Rate-sensitive utilities and REITs, which usually bounce with bonds, are holding up better than other sectors. Foreign markets are selling off as well. It looks like a bad end to the week for global stocks. VIX bounces off the 20 support level. After dipping below the 20 level briefly, the VIX has rebounded. A VIX bounce off the 20 level isn't good for stocks. We'll be watching that if the 20 support level holds. Fed inaction boosts bonds and safe haven assets while hurting stocks. With short-term bounce ending, a retest of summer low appears likely between now and October. That will help determine if this is a correction or a bear. Fed decision to leave rates alone shakes markets. I'm not sure what the Fed said on Thursday that got everyone upset. It acknowledged weakness in foreign markets like China and low inflation. We already knew about plunging Chinese stocks and weak commodity prices. Even so, markets took a decidedly negative turn on the Fed inaction. Global stocks sold off sharply as bond yields plunged. Money moved out of stocks and into safe haven bonds and gold. Gold is a non-yielding asset that benefits from low rates. A sharp drop in the dollar on Thursday also helped gold. Bond proxies like utilities and REITs gained ground, while banks and insurers sold off sharply. Banks have been rallying in hopes of higher rates and got hit hard by the plunge in bond yields. Economically sensitive commodities like copper and oil also fell sharply, along with the related stocks. Foreign stocks also fell. All in all, a bad week for risk assets. Which brings us back to the bigger question of whether the August price plunge was a normal correction or something more serious. A bounce off that low was expected, but has now run its course. A retest of the summer low was also expected between September and October. It appears that's where the market is now heading. And then short-term bounce is over. The rising wedge pattern suggests that a short-term rebound in the S&P 500 has ended. A rising wedge is identified by two rising trend lines that also converge. A break of the lower line would confirm the bounce has ended. The volume pattern confirms that negative view. Volume was light during the price rebound, but before turning higher on Thursday and Friday as prices fell. Although some of Friday's volume can be attributed to the expiration of futures and options, it was still the third heaviest trading day of the year. That suggests a lot of selling. It also suggests that a retest of the August low is likely. So what's the difference between a correction and a bear? The question about whether the market is a normal correction or something more serious. We'll soon find out. I've leaned toward the correction view, a drop of 10 to 15%, but a lot of longer-term indicators suggest a more serious decline, 20% or more. The only way we'll know for sure is whether or not previous support levels hold. The daily bars put the recent trend stock rebound in better perspective. Thursday's downside reversal day in the S&P 500 took place just shy of the 62% retracement line. The Dow bounce ended closer to the 50% line. These are normal spots for a counter trend bounce to end. The SPX also fell short of its 50-day average. The 50-day also remains below the 200-day line, which is a negative sign. The normal expectation is for a retest of the August low, which means that a loss of minus 12% from its May high. A drop to more important support at last October's low near 1820 would constitute a loss of 15% from its May high, which is still correction territory. But that low has to hold if this is just a correction. The month of October is also very important. All we can say with some degree of confidence at this point is that prices are probably headed lower in the weeks ahead, most likely into October. How much lower will depend on whether or not previous lows hold. In the meantime, a very cautious stance is warranted. And then finally, foreign stocks are also testing an important support line. Ms. Yellen has good reason to be concerned about weakness in foreign markets and emerging markets in particular. They've been the biggest losers among global stock markets. Since May 1st, emerging markets have lost 20% versus 10% for foreign developed markets and 6% for the U.S. What happens there does affect what happens here, and those foreign markets are testing important support levels of their own. The weekly bars show the emerging markets EEM testing support at its 2011 low. That's a very important test for it and the rest of the world. EFA, which is developed markets, tested trendline support drawn under its 2009-2011 lows. That's also an important test. Their weekly RSI lines are in oversold territory, but that won't be much comfort if their support levels don't hold. That would give Ms. Yellen and the Fed a lot more to worry about. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7 a.m. Central Time, and I'm recording this in preparation for the market day of September the 21st, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So we had quite a bit of content there from the morning reading. Obviously, a lot of things happened at the end of last week, and that was a big contributor. These are some very important times. So let's just kind of keep all that in context. Take that as kind of a global macro view, and then we'll dial into what are we dealing with this morning. In the morning report, our overnight action from the 8 futures markets that we follow, the 4 broad U.S. indices are all up, and S&P, NASDAQ, Dow are all up about 0.4% at the time of this cut. Russell, the weakest, just up marginally, with crude oil up 1.75%, the euro down about 0.75%, bonds down about 0.4%, and gold down marginally. In overseas action, Asia is mixed. China up 1.9%, Hong Kong down about 0.75%, and Japan down about 2%. And Europe, it's also mixed. Germany's down about 0.7%, United Kingdom's up about 0.5%. So some really, really mixed signals coming from overseas action. Bottom line is our own markets are slightly up at the time of this cut. They were down pretty significantly in the Sunday night action, but rebounded from that and are now up about 0.4%. In terms of macroeconomic reports for today, you have existing home sales, and you have FOMC member Lockhart speaking, and I saw a quote that was kind of interesting, that this may be the most interest rate sensitive market that we have had in many, many, many years. And anytime you get an FOMC member speaking at this point of the Fed cycle, it could move things. So this could be a yawner, or it could trigger something bigger. So always keep in mind just how sensitive the current markets are. I mean, you'd think it's only 1/4%, but given that it's been 9 years since we've had an interest rate increase, everybody is very, very much aware of when that process starts and when those dominoes start to fall. In terms of tomorrow, U.S. macroeconomic reports, you have Lockhart speaking again, and that looks to be it of significance. Let's take a look at the current volatility situation. Skew relatively benign. Short-term VIX 21.78. Certainly, it's been higher of late. We had pretty big moves on Friday, though. 2 standard deviation move on the S&P, 1 standard deviation move on the other 3 indices. IV percentiles are closer to being in the bottom third than they are to the midpoint. So things are relatively low compared to where they have been in the last 4 weeks. So kind of keep that in mind. In terms of standard deviation moves, obviously you had the 2 standard deviation move on Friday, and in total we're still experiencing a little bit above average volatility, both in terms of the magnitude of the moves as well as in the number of moves during the last 2 trading weeks. In terms of our regular daily reports, several little changes here. I'm still thinking that this is trend breaking, phase 2, likely to, at the very least, revisit those recent lows. A quick look at these charts here. We had this false breakout of the top side of the ascending triangle, or on some of these indices, what might be seen as a pennant. But then with Friday's action, we actually came back into that triangle and then closed below the diagonal support of that pattern. So that is really very, very bearish. Also, if you take into account this 3 candle pattern, obviously we talked about the big wick here, and then we had a bearish confirmation of that reversal pattern here. So false breakout, big wick, looking for confirmation. We got it, and even more importantly, we got to close down below the diagonal support. So we'll watch today's candle very closely. Obviously, if we close back inside the triangle, that will be a bit confusing. If we do break down today and then close and follow through with another close below this diagonal support, we may take that as just more evidence that we're likely to go down here to the prior lows. In terms of the Russell, also a reversal pattern there, though not necessarily a break of the diagonal support from the pennant, which would be drawn right through here. So the Russell actually held up Friday a little bit better than the S&P. NASDAQ, also a reversal pattern here, and a close below that diagonal support. So like the S&P, pretty bearish, though not as bearish as the S&P in terms of it's not that big red body there. And then, of course, the Dow, very much like the S&P, you had the false breakout, reversal pattern, and then breakdown below the diagonal support. Though of interest, the S&P was probably the weakest of the 4 indices, which is never ever good. And a quick look at bonds, and you see what's happening. A big gap there with bonds as measured through the TLT. Right here. And then also let's take a look at gold as expressed with the ETF GLT, a gap. And if this breaks out at the top of the Ichi cloud, that would be an Ichimoku breakout, cloud breakout, and we could very well see this move at least to these prior swing highs at the 112 area. And there's potential that we could see a bigger move if the market breaks down into the 114 area. So this has been pretty interesting. Now, I have to say that there's been, a couple attempts to reverse this long-term bearish market in gold in recent months, and frankly, each one of them has ultimately failed and then legged back down. So it's hard to get too excited about gold turning bullish. But if the broad market does turn significantly bearish, gold will then become a safe haven asset, and we'll start to see significantly more interest. Back to our daily report. In terms of investor postures, IBD status remains uptrend under pressure. Accumulation distribution at a D plus for the S&P and NASDAQ and E. GMI index improved a little bit to a 2 out of 6, but that still is a sell signal, and that author still remains very, very conservative in cash. Primary bear market condition still remains as a strong bear. The decision point scoreboards, you see, while we've had some short-term mechanical signals coming in, the rest of the time frames, intermediate and long-term across each of these markets, remains down. And this right here would seem to be, when we look at the charts, that false breakout. And now we know a failure of that false breakout, it would appear. The intermediate term market posture is a weak bull, and we have on the S&P 44.1. Dow's actually outright bullish, and NASDAQ is bullish, and Russell also is weakly bullish. So that intermediate term posture has been holding up during some of this recent pennant action, but it's not been supported by a lot of other indicators. Overall hedge warning status remains a threshold level 2, a red light, and indeed with some of the content from the morning reading and so forth, would certainly seem to be a legitimate elevation of risk assessment. Indeed, if you look at the some of the individual metrics that go into this, especially those from volatility, the market in decline and sharp increase warnings fired on Friday once again. VIX remains above an 18. Distribution day continues to climb even from the recent reset. We're already at 3 on the S&P and NASDAQ. You have on the New York Stock Exchange, new highs, new lows. It was relatively benign on Friday with 95 new highs, 146 new lows. This was a change of the risk aversion indicators. We now have 3 of the 5 that are risk off. Remember, all 5 of those were risk on, so that was a deterioration. In terms of special opinions, VIX is outside the acceptable window, so we continue to be very, very cautious about the initiation of new option income strategies. Going to need to be quite a nimble trader at the adjusting techniques should Delta or Vega start to significantly elevate as a result of a breakdown in the broad market. Cover call strategies, conditions are borderline acceptable to initiate new positions for novice traders with reduced positions and in the money strikes. So that's about as conservative as you can get and still say you can put something on in that opinion. Aggressive traders consider reduced position size or legging into cover calls through well out of the money put selling. Keep position size in the scale you are willing to own. Put selling conditions are also borderline acceptable for new core put portfolio positions. Novice traders consider reduced position size and well out of the money puts. Consider defined risk positions, spread those things off, and position size in the scale you are willing to own. Aggressive traders should consider scaling into those full positions. So if this indeed turns into something of just simply a sideways pattern, and this swing bottom holds, then that would seem to say that it's okay to start scaling into some very, very light positions and start accumulating some activity. But at the same time, most of the indications are actually indicating that we could come down and test this area, maybe not exactly to the tick, but somewhere within 1 or 2% of this area, form something of a W pattern before the end or the bottom is in place. So if that were to happen, then all the stuff that you are putting on today, tomorrow kind of thing, could very much take a lot of heat prior to that turn coming into place. The other option, of course, is that that this area doesn't hold, at which point we go down to the prior swing low from last October, and that would be about a 15% drop from the May highs. And again, if this doesn't hold, that brings into serious questions the strength of the market. If this one doesn't hold, then we're likely in a full-out bear market, and you could see why putting new positions on at this point, brings some additional risk parameters. So keep those positions small if you should nibble, and consider defined risk and the like. In terms of sector-specific relative rotation graph from Friday, take a look at who's doing well. Utilities, and then home construction and the internet. And so FDN is probably the strongest, and I do have a position in that one as part of my core portfolio right now. That one has been actually holding up really quite well on all time frames, whether you look at short, intermediate, or even longer term time frames. So that has been an area of strength, both in terms of relative strength as well as absolute. ITB, your home construction, we've been talking about that one of late, though. While it's certainly in the right quadrant, it's certainly green. Notice it's kind of flat. So perhaps of the three, that one would have the pattern that's most concerning. And then XLU, of course, is the utilities, and we made several references to utilities from the morning reading content. So there is also something there to consider. In terms of spider sector specific, you see everything was down, and see, this is the concern when you go into a bear market. So FDN, utilities, everything can go down if this turns decidedly bearish. So got to keep those positions either well hedged or well position sized when you're dealing with a market condition like we have right now. And you see the market postures. This, as we said, if we get any kind of bearish action, could turn quite red quite quickly. On Friday morning, these had a lot of greens and neutrals. Well, those got wiped out in a hurry with the action on Friday, and pretty much all red all the time across all sectors, all time frames at this point. So that is more than enough for today. We went a little long, but I hope you found that content and other information was extremely helpful to you. A lot happening in the market in recent days. If you find what we're doing here is helpful to your trading, we greatly appreciate you retweeting us to your Twitter followers, to your StockTwit followers, liking us on YouTube, subscribing to us on YouTube, all the various kinds of ways that you can support and show appreciation through social media. Emails can be sent directly to support@falconglobaltraders.com. More information about how we apply these principles into our trading can be found at this website. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. And we'll see you back here tomorrow morning before the market opens with the Falcon Global Market Preview. Good trading.